In this video, we will take a quick look at the S&P 500, explore reasonable bounds for a bear market rally, and review the bearish case, which remains intact from an intermediate to long-term perspective. This is a daily chart of the S&P 500 index. This is a mess. This is somewhat of a trendless trading range. You had a higher high here, a lower low here. In this video, we're going to try to take a step back and try to determine if we break out to the upside, how far could we go? And we've already talked in other videos that we believe the immediate downside risk here would be somewhere between 1050 and 1020 for the next leg down. Here, it looked like last Thursday that we had broken this trend line, and it looked like it was somewhat inevitable that we were going to break out of this trading range and move down. And as you'll see on some other charts, if we do break this, we could see a rapid descent. However, last Friday we got a little bounce, no big deal here. And then Monday, things were quiet and we were well below this trend line around 2 o'clock. And then CNBC broke the story about Europe levering up the bailout fund for Greece, and we popped back above it. So this almost became a failed breakout, and then in today's session, we remained above this blue line. This is a weekly chart of the S&P 500. What we're trying to determine here is logically, if we rally further to the upside, how far might the rally take us? So let's look at the previous bull market and bear market and review some concepts that really apply to all markets on different time frames. The concept is simple. This blue trend line acted as support for prices several times during this bull market. Once you break below the support line, what once was support now becomes resistance. So you can see when we peaked in October of 2007, we came down to these moving averages, which we'll talk more about on the next chart. Came down to these moving averages, we clustered for a while, then we bounced. And then we bounced back to the intersection of this downward sloping trend line, which was this, and this upward sloping trend line. So if we take it to the present day, this line here is similar to this line here in the last bull market. Support, support, support. Now it's acting as resistance just as it did here. The takeaway here is if this continues to act as resistance as it did here on this big bounce, it says our upside is somewhat limited. We'll probably run into this downward sloping trend line, and the intersection of the two may come into play anywhere between, let's say, 1249-ish, 1230-ish, all the way up to 1260. So 1230 to 1260 seems to be a reasonable analogy to what happened here. This is another weekly chart of the S&P 500. These are clusters or bands of moving averages, and these are the moving averages over here. So this is the 20-week moving average. This is another cluster. First, let's talk about the bearish case. Is the bearish case still intact? We believe, from a probabilistic standpoint, the answer to that question is a definitive yes. Let's look at when the last bear market started. If you go back further off of this chart, what you'll find is these moving average bands here, from here to here, pretty much bounded the bull market. When the bear market started was here, pretty much officially, when we went below this band. And you'll notice when the bear market started to pick up speed was in late 2007, early 2008, and this was a clear bearish signal right here. Now you'll notice once we crossed below that, during the whole bear market, we never popped back above in a bullish manner. So what we want to learn today is the bull market peaked. It became probabilistic, or the odds favored lower lows beginning about right here on many fronts. We came down to this band of moving averages, and we clustered, and then we bounced. The takeaway on the bounces is that we went all the way back to the top of these bands. So let's use a similar concept. During this bull market, price was bound and stayed in these moving average bands pretty much the whole time. The bands acted as support here, here, and here. You'll notice these bands that acted as support acted as resistance, strong resistance here, and we bounced back down. Another good takeaway is when we hit this band of moving averages, you'll notice here the established trend is down. Eventually, when it's down, we broke through. And notice when we broke through, we went down fast, we came up and tested it, and then the bear market, really took off. So how does this help us today? How it helps us today is just like these moving average bands acted as support in 2008, they're acting as support now. What it tells us is if we break below roughly 1100, we'll probably move down fairly rapidly, and we may come back up and retest it. But eventually what it probably tells us is if you break here and get a weekly close below it, as we did here, it probably says that the losses would pick up steam on the other side of this band here. So the main reason why we're looking at this, we're trying to determine if we get a rally, how high could we go? Well, when we rallied here, we went all the way back to the top of these moving average bands. So let's follow them around, and this is where they are now. They're up here. And we wrote an article, I believe on August 12th, that said even if we're in a bear market, we could easily rally back to 1260. And how we got 1260 was this is a head and shoulders topping pattern. This is a shoulder, this is the head, and this is a shoulder. The neckline would be drawn in here, which would come in as resistance. There'd be a resistance line here, right around 1260. So a move back to 1230, 1260, and the high end of this range is actually 1280, would even be in the realm of possibility. Now, the purpose here is not to forecast that that's where we're going, but as far as managing bearish positions from a risk-reward standpoint, you have to respect that with today's close of 1175, it's within the realm of reason if we bounced like we did here, and this is a 14.6% rally from here to point A up at the top here. And it just so happens that a 14.6% rally from this point here takes you to 1260, which is this neckline. So we wouldn't be surprised to see the market rally. We doubt that the market would, under any bullish circumstances, exceed 1280, and if it did for any length of time, the most logical place of resistance probably comes in really anywhere between 1200 and 1260 would be a logical place for us to potentially reverse and to resume what appears to be a bear market, because you'll notice as we were on the other side of these trend lines here, we are now on the other side of them here, which is different from the whole bull market. We stayed above them, now we're below them, and that looks like this area here, and eventually we broke lower. This is the SH daily chart ETF. So this is a ETF that goes up when the S&P 500 goes down. So it's an inverse ETF. What we want to talk about here is a little bit about our style of risk management with short positions. A couple points here about is the bull market intact. SH, is it in a bull market? Well, it looks like a bull market. The red line is the 200-day moving average. Price is above it. That's bullish. The 200 days trying to turn up. If it does turn up, that's bullish. Here's your golden cross. This blue line is the 50-day moving average. It's above the 200-day. That's what a bull market looks like. And even the 100-day here, price is above the pink line, which is the 100-day. And notice the slope of the 100-day. Now, in terms of risk management, This is obviously bullish. This is a short-term downtrend. In technical analysis, this is known as a bullish flag continuation pattern. Here's your flag pole, and this is the flag itself. Typically what happens with this pattern is you get a breakout like we did right here, this black line, on Thursday of last week. This is a bullish breakout, and more often than not, it tells you that the uptrend will continue. From a risk management standpoint, we have moved back into, and this is as of Monday's close. So Tuesday's close is actually just in between these two lines right here, sitting below this green line and above the blue line. So this is technically a failed breakout. You just want to make sure that you don't let losses run on short positions too long. So we talked about the upside potential on the S&P 500. When we entered the trading day today, on Tuesday, the close on Monday was 1162 on the S&P 500. We just talked about that it's conceivable, maybe not likely, but conceivable within the context of a bear market from several perspectives, that the S&P 500 could rally 100 points from 1162 all the way up to 1260. It's also conceivable within the context of a bear market that the S&P 500 rallies all the way back to its 200-day moving average, which is 1280. So as far as your confidence goes, and just good risk management, if you're wrong, we have a tendency to admit it quickly and just say we believe that we'll be able to re-enter this market. We're confident that we can make money on this position at some point. We're just not all that happy with how this risk-reward ratio deteriorated. Now, it's possible that we bounce right back up. How would you understand when the odds have improved? This is a downtrend here, this green line. There's three things that really need to happen for a change in trend. So the short-term trend here is down. The first thing you need to do is break above the trend line. Well, we did that. The second thing you need to do is you need to make a higher low. So what we need is if the market goes up and SH comes down, you need it to make a low above 43. If it makes a low in here or here even, if Tuesday was the low, when you get the quote-unquote confirmation, and obviously nothing is certain, it's a probabilistic confirmation, would be when you exceed this high. So step one is to break the trend line. Step two is to have a higher low relative to this low. And step three is to have a higher high, which would be relative to this high right here. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.